Banking is a business activity of safeguarding money owned by individuals and entities and lending out this money to earn profit. The main objective of bank is taking money from people who is surplusly having it and giving it in the hands of people who are in need of it. The money remaining idle in the hands of people will not promote the economy of our country. Hence, bank takes initiation to promote our economy, thus lending the money to investors for the growth of economy. Meanwhile, bank will also earn profit in it. However, with the passage of time, the activities covered by banking business have widened and now various other services are also offered by banks. The banking services these days include issuing debit cards, credit cards, providing safe custody of valuable items, ATM services, online transfer of funds across the country or world. Now let's see how bank make money to earn profit. Bank borrows money from depositors at low interest. The bank lends this money to borrowers at high interest. Bank will earn profit from the differences in the interest rates. For example, John is depositing rupees 50,000 in SBI Bank for 5% of interest rate. Bank will give rupees 2,500 as interest to John. Now the bank is lending this amount rupees 5,000 as a loan to David for 9% interest rate. So the bank will get rupees 4,500 from David as an interest rate. Now the difference between the interest rates 4,500 and 2,500 is rupees 2,000. This amount is the profit of the bank. The main functions of banks are primary function and secondary function. The primary function of banks are accepting the deposit and granting loans. Now let's discuss about accepting deposit. Banks accept deposit from individuals in four forms. They are fixed deposit, current deposit, saving deposit, and recurring deposit. Fixed deposit is a type of account where the account holder deposits certain amount for a fixed period of time. In return, the account holder will get a fixed rate of interest. The account holder in fixed deposit cannot withdraw their money in between the fixed period of time. However, in emergency, the account holder can withdraw his money, but he has to pay certain fees to the bank. The rate of interest for fixed deposit is higher while comparing to all other forms of deposits. The time period for fixed deposit is minimum 7 days to maximum 10 years. The liquidity in fixed deposit is lesser. The account holders cannot withdraw their money when they wish to have it immediately. Saving deposit is a safe way to save your money. This is the basic type of account. You can withdraw money at any time with the help of ATM cards. Saving banks provide you less interest and the bank will provide interest once in a month if the total sum of amount maintained in bank is more than the minimum amount set by the bank. If your withdrawal exceeds certain limit, then you have to pay certain fees to the bank. Current account is a type of deposit account maintained by individuals who carry out higher number of transactions with banks on a regular basis. Usually, business people use this type of current deposit account to carry out their day-to-day business transactions. There is no interest rate for current account. Current account holders can have higher transaction limit comparing to other account types. This allows the current account holders to conduct a large volume of transactions. When current account holders are dealing with business transaction, such flexibility in transaction will be highly useful to them. A recurring deposit is a special kind of term deposit offered by bank which help people with regular income to deposit a fixed amount every month into their recurring deposit account and earn interest rate applicable to fixed deposit. It is similar to making fixed deposit of a certain amount in monthly installment. This deposit matures on a specific date in the future along with all the deposits made every month. Recurring deposits allow customers an opportunity to build up their saving through a regular monthly deposits of a fixed sum over a fixed period of time. The minimum period of recurring deposit is 6 months and the maximum is 10 years. Now we can discuss about the second type of primary function, that is granting loans. We have three types of granting loans and they are overdraft, cash credit and term loan. So when the bank accepts the deposit, then it has to invest those funds, right? So what the bank will do? It can lend to general public or companies. Lending of fund can be done through overdraft. Overdraft is the facility provided by the bank to its customer to withdraw more amount from the bank than the amount actually present in the bank. For example, you have rupees 30,000 in your bank account, but you need rupees 40,000 urgently. Now, the bank will give you the option to withdraw rupees 40,000. That is, the bank will give you the option to withdraw more money from your account than what is actually present in your account. An authorized overdraft limit is assigned for each customer depending on their past repay history or customer's relationship with the bank. The customer may withdraw money till assigned limit. Overdraft is a short-term credit. Customers can repay within short duration. You can use your current account or saving account to avail this function of overdraft. If the customer wishes to add overdraft protection to their account, they must apply for this service just like they would do for any other credit facility. The bank review the application and approval is subject to customer's credit worthiness. Bankers normally review whether to continue extending overdraft protection to the customer on a regular basis. There is no tax deduction on the interest rate paid for the overdraft protection. No collateral is also needed in case of overdraft. The interest rate charged by lenders for overdraft is higher when comparing to cash credit. Cash credit is a short-term loan provided by bank. Business accounts are more likely to receive cash credit and it typically needs collateral. It is commonly offered to business rather than individual. Let's say you have some cash. You are going to use that cash for purchasing raw materials. Then the next step is production. Then finished good. It is not necessary your finished goods will sell immediately. Even if customers buy, most of them will ask for credit. So you will not get cash immediately. but your business need fund to carry out your day-to-day activities. Your business need working capital fund. Bank is offering cash credit to business people to meet their working capital requirements. Assets like inventory, finished goods will be taken as collateral. Interest payment made on cash credit or tax deductible, in which business people can use cash credit to lower their tax burden. Overdraft can be availed based on credit history and customers' relationship with the bank. Cash credit can be availed based on the amount of the collateral. Cash credit is a short-term credit where the interest rate is lower while comparing to overdraft. A term loan is a monetary loan for a fixed amount repaid in a regular payment over a set of period of time. This regular repayment schedule is called as equated monthly installment. It can be offered in both fixed rate and floating rate. Tenure is decided at the time of loan application. Home loan, educational loan, and car loan are based on this. For example, Lydia requires a sum of rupees 10,000 for buying a mobile phone. She approaches a bank for term loan. The bank accepts to offer term loan for Lydia for rupees 10,000. Tenure is for 20 months with interest rate 7%, which is a fixed interest rate.